All right. Well, good day, everyone. Welcome to today's webinar. My name is Steve Jackson. I'm the Senior Vice President of Strategic Development and Channel Sales here at PrimePay, and I am just thrilled that you have taken a day here out of your August to come and sit with us here today. We've been fortunate, due to many of you that are on the webcast here today as partners, to be able to present and participate in these webinars on the first Wednesday of every month for the last 8 years, and so we're grateful of the commitment and the partnership that we've been able to work together here these many years. So let's go over a little bit of the ground rules here today before we get started. You know, as most of you know and realize, your phone lines are muted. We've got quite a few folks on here today. What we would ask though is that we still would like to hear from you. Okay, and what you can do is you can go into the Go to Meeting menu bar. There's a question box there. You can type in your question. I will do my very best that if I'm able to tackle the question as I'm going through the webinar, I will do so. If we have time at the end, I will try to look at some of those questions as well and provide some answers. But in the very least, if I'm unable to do so, we will absolutely get back to you offline and provide you with the answers to those questions. You know, and also a main question that I do receive is, are you recording this webinar? We'd love a copy. We absolutely are recording this session, and we are happy to give it to you. So one way that you can view it is go to our Broker Concierge channel on YouTube. And you can actually view any webinar. We've probably published most of the webinars that we've done over the last couple years directly on that site. And generally just give us a couple days, but we will get this recording then on that YouTube channel here momentarily. So you will have that, and you can subscribe to that so that you can actually just, you'll get the email reflecting when that actually was downloaded and ready for viewing. So we're so grateful that you have taken time out of your busy schedules to sit with us here today. The title of today's webcast is Avoiding the Most Common ERISA Mistakes. You know, we've done several webinars here over the last year to 2 years. And the reason that this issue, this topic continues to come up is that we clearly are hearing from you as the benefits broker, the consultant, that ERISA compliance is becoming more and more and more important to your clients. Because, right, a lot of what you do is a reaction, right, to their needs, their challenges, the issues that they're facing, and your ultimate goal is to drive a lot of value and drive a lot of support, compliance support, administration support, benefit support, cost-saving support, you know, ultimately to your clients. And so this ERISA thing is really starting to flourish here more. And I guess what I wanted to kind of show here is that, you know, when we look at the agency or the department that actually enforces ERISA on clients. You know, Department of Labor has been the major enforcement agency or department for ERISA going back to when, you know, 1974 when ERISA began. And yes, in large part, the enforcement of ERISA has really focused and honed in over the years on pension benefits, clearly, the 401ks, the retirement plans, a lot of the fines and penalties that have been levied. You know, they're great, a large number of those enforcement liabilities have fallen on the pension side of things. But as you know, and you're quite aware, is that the Affordable Care Act has put that kind of target on the back of health and welfare benefit plans as it pertains to ERISA. And the Department of Labor, so the major enforcement agency or department of ERISA, has stated that 3 out of 4 employers are out of compliance with ERISA. So here, the main department that enforces it knows out of the starting gate that 3 out of the 4 employers that they're going to visit in an audit mission, that they're going to find 3 out of those 4 out of complete compliance. And so I actually wanted to get your take actually on this very question. And so if you would, you're at your computers already, I'm going to launch a poll question here for you. And I would love to see your answer, okay? So if you would, look at the poll question here that's on your computer and answer this question for me by selecting just one. So now you know what the Department of Labor thinks. They know that the majority of your clients are out of compliance with ERISA. So what percentage, though, do you think your clients are out of compliance with ERISA as it pertains to the health and welfare benefits? All right, clock is ticking. Go ahead and click through. Make your selection of what you think your clients, out of all your clients, who is compliant. Is it less than 50%, or is it all the other way where it's 100% or all are compliant with ERISA? So go ahead and select your answer. We'll just take a brief few seconds here. We actually have a very large number of benefits brokers on here today, so it should be a very interesting answer here to our question to see it live. I'll just give you a few more seconds. All right, I am going to close the poll, and let me go ahead and share that here for you. So as that pops up here, so as you all had answered that question here, about less than 50% say about a quarter, 25% of you say that less than 50% are actually out of compliance, but 65% say that between 50 and 90% of your clients are out of compliance. So very, very interesting. Very interesting. At PrimePay, we have been fortunate to be able to be part of helping employers comply with ERISA and health and welfare benefits here over the last couple years. And I will say what we see here at PrimePay is a number that's right around 9 out of 10 employers are out of compliance with their ERISA compliance for health and welfare benefits. Okay? So thank you for that feedback. It is just very good to see that documented, and it probably gives you some perspective as well as what other brokers see with their clients. So today's agenda, we've got a lot to talk about, some really good content that I think will be valuable here for you, and it's really focused on these three things. So first off, I do want to talk about the latest proposed changes to Form 5500. Very important. There are two key changes that can dramatically change what small employers have to do in regard to Form 5500, and also the information that will need to be gathered is also very important. So I do want to cover that. We do then have, as part of our main content here for you today, is that I asked our ERISA team, I want you to look at, all of the common mistakes that you see employers are making here in regard to fulfilling their obligation of ERISA. And so they came up with 7 most common ERISA mistakes to avoid. And so these are mistakes that are not easy to overcome. They are easy to overcome, but these are commonly just failures or mistakes that employers make that we need to bring to your attention, which could drive some great discussion here for your clients. And lastly, we want to provide the most recent update on the increases to ERISA penalties. As of August 1st, penalties for or under ERISA, as it would be enforced, have increased. And just here, as of Monday. So let's go over those final penalty increases so that you understand them fully and how to communicate those as well. All right, so the first thing that I want to cover here is the proposed modifications to Form 5500. So on July 12th, okay, just last month, the Department of Labor, the IRS, and the Pension Benefit Guaranty Corporation released these proposed changes. Now, in some regard, it did come out with a little greater fanfare, okay? So it wasn't something that was just kind of hidden and kind of quiet. These were major modifications, actually, to Form 5500. They were pretty dynamic, pretty comprehensive, extensive in regard to how they want to modify how an employer would file Form 5500. Now, as you look at the date, the effective implementation of these proposed changes would not come into effect until the 2019 plan year filing. So you might be sitting here going, Steve, come on, it's 3 years out. Why are you bringing this up? Well, we all remember back in 2010 this little-known act called the Affordable Care Act that kind of came up, and there was this thing called the Cadillac tax that was supposed to come out here in 2018, and we said, oh, that's 8 years down the road. And sure enough, even though it was delayed here 2 years, these years go by very quickly, and your employers will need to begin thinking about how they might be impacted with these proposed changes. Now, they are proposed. They are not final here as of yet. The IRS, the other agencies are taking public comments here right now through October, and so I would strongly suggest that you do provide your public comments to the Department of Labor in regard to these proposed changes. So again, only proposed. So what were those key changes? So as you are probably aware, a large employer that has 100 employees or more were generally the ones who were required to file Form 5500. Small employers, okay, generally, really pretty much across the board, there was an exemption. Under these proposed changes, it has eliminated the exemption for small, fully insured, unfunded, or a combination thereof of welfare benefits. So the Form 5500 filing, where small employers were exempt, under these proposed rules would now be required to file Form 5500. So think about the benefits, not just medical benefits and dental and group term life and disability and so forth. Think about a health FSA, think about a health reimbursement arrangement, an HRA, which it now would be affected. So I've said it in the proposed way here, in the bullets there, I've said the same thing probably 3 different ways, just to be clear. But so this will affect, so Form 5500 filing will affect employers with fewer than 100 covered participants at the beginning or the start of the plan year. So the main requirement would be that small employers will be required to file Form 5500 under these proposed rules. It's significant. That's a significant change and significant based on the type of offerings that they provide. Any ERISA qualified plan, that small employer now would be required to file. Let's look at a couple other key changes that are also going to be in place. What's also new to this is that they have also added an additional schedule, Schedule J. Okay, so Schedule J is really collecting information about the following, okay, and in very high level here: health plan operations, insurance company relationships, for the financial management of the plan. Kind of those are the key kind of topical the main topics of what is going to be added. But let me just share with you some of the granular things that employers are going to need to add on this Schedule J. So part of this schedule will include these things, these questions. So, employer, how many individuals are receiving COBRA coverage through the plan? Who is covered under the plan? Are you covering all employees, spouses, dependents, retirees, and so forth? Is the plan a high deductible plan? Do you have a plan here that is an FSA or an HRA? Is the plan claiming grandfathered status under ACA? What's the total premium payment and other details regarding your stop-loss coverage? Tell me a little more information about claims payment information, which and please include the counts of claims approved and denied with a dollar amount of all claims paid, counts of benefit claims appeals, counts of benefit claims adjudicated, those that were adjudicated late, those pre-service claims that were appealed, so on and so forth. So this isn't a replacement, folks, of Forms 1094 and 1095. Okay, ACA is still requiring kind of those key data fields to be populated in regard to whether an employee was eligible for coverage and if they had coverage and who did they cover and so forth. But Schedule J is very comprehensive, and it's not a schedule that's going to replace Schedules A and or C. Okay, this is an additional schedule that would also be included. Now, under the proposed rules, large plans generally, we're assuming here at this point, 100 or more covered participants, large plans will be required to answer it in full. But it does appear that small plans will get by with more of a limited number of those questions that they will have to answer. One of the questions that did come up here today is on covered participants, and what you can generally consider as who is a covered participant would be an enrolled employee. Okay, and it can also include those beneficiaries, okay, of those who are covered. But in the general rule of thumb, when you think about covered, who is a covered participant, it would be an enrolled employee. Okay, so again, these are proposed, but fairly significant, wouldn't you think? So small employers are going to now have to adopt a Form 5500 filing requirement, and then this Schedule J poses additional administrative tasks for all of the employers here at the end of the day. Okay, so mistakes are going to happen, right? I would say this, that in any audit type of situation that we have certainly seen or heard or you see results from, mistakes are going to happen. Employers may not be aware of every single requirement and obligation, but what the Department of Labor is looking for as well is intent, right? I mean, you have tried to take due diligence and tried to ensure that you are fulfilling all of the specific obligations and requirements. So mistakes will happen. The IRS, or not the IRS, the Department of Labor will, certainly, ask for corrections to be made, and as long as those employers make those corrections, generally the fines or penalties maybe, although assessed, maybe they're not assessed as much, as if an employer just willfully refused to comply, with these regulations. So we do see a lot of mistakes, and what we've done is kind of consolidate these into 7 common mistakes. And I think here at the end of the day that the 7 mistakes can be easily avoided here at the end of the day. So let's look at mistake number 1. All right, the number 1 common mistake, and this is the most basic of basic, but it's the failure to report and disclose plan information. There is a common misconception, I would say, with certainly small employers, that many small employers, they state, we're not obligated. We do not fall under these specific requirements. We are not obligated to actually comply with these specific requirements. There's also a misunderstanding that the insurance carriers, the TPAs, or other particular partners would be supplying the needed ERISA requirement paperwork. That it's given by someone else. Okay, so it's not really an obligation of the employer. As you may know, though, the plan sponsor, which is generally the employer, is the one that is certainly liable for not providing the appropriate ERISA documentation. And so to reemphasize here, all employers are subject to ERISA. Now, unless you are an agency here today that your niche is to work only with government entities and churches, then I bid you well. You can sign off this webcast and move on. But it's probably not the case. Most of you have a more diversified portfolio of industries, of clients, and so forth. So all employers, and even to take it a step further, is that employers offering a group health plan or certainly other ERISA qualified plans to 2 or more employees are also covered. Many small employers feel that, hey, I've got 5 employees, I have 25 employees, I have 45 employees. It doesn't affect me. I don't need to comply. But those pieces here, all employers, and then really all employers of any size, but for those a couple exemptions, they are going to be required to report and disclose ERISA plan information to their participants, okay, those covered enrolled employees. So plans include, one of the other kind of pieces of confusion that causes some mistakes is just all of the plans that do qualify. And I didn't list everything here, okay, per se, but you've got medical plans, group dental plans, group vision plans, you know, group term life, AD&D, long-term disability, short-term disability plans. You have certainly voluntary plans, even those under Section 125 that are group plans that, you know, would also need to comply. You have, and often forgotten, if you have a health FSA or an HRA, these are ERISA qualified plans. Now, there could be several others. You could have a more comprehensive wellness benefit or a employee assistance program that could also tie those into ERISA. You could have a severance policy and program that the way it's funded, the way it's operating could become an ERISA qualified plan. But generally, these are, you know, kind of the main ones, the main products, the main plans that would constitute ERISA qualified plans. And so the key thing to this failure or to this mistake is at the end of the day, this summary plan description, which doesn't encapsulate every bit of the regulations, but it houses much of the notices and disclosures that are needed from an employer distributed to that covered employee. All right. So the summary plan description, when you look at many of the lawsuits, many of the audits that are being had and done here by the Department of Labor, they are focused in on, hey, what have you disclosed? What have you, reported, maybe in a Form 5500, but what have you disclosed to your employees? So have you been distributing a summary plan description within 90 days after the participant becomes covered under the plan? Have you been distributing a copy of the SPD within 30 days of a particular request? One of the biggest mistakes that employers are making is assuming that a certificate of insurance or quite possibly a benefit plan summary is their ERISA document. It's not. I mean, it would be so rare that it could be. A certificate of insurance just does not carry enough of the information needed in order to be an ERISA plan document or certainly an ERISA summary plan description. So the summary plan description, this is a separate document. This is a separate distribution that is made. This has nothing to do right here with a Section 125 plan document, SPD, or a Section 105, like an HRA SPD. This would be a more formal ERISA summary plan description. And so just to, I think everybody here on the call probably understands, but what is that summary plan description? It's meant to be that main communication piece that's given to the employees that explains their benefit offerings, right? Explains eligibility, it explains waiting periods, it explains funding operations, funding methods, and I mean all of those things, and it provides them with enough information so that they can make maybe better decisions, ultimately. Let me just touch on then this main piece on the summary plan description, just to highlight how important it is and how critical financially this decision of an employer not distributing the SPDs, what it means. So if you do not distribute, just say within 30 days of a request from a covered employee, an enrolled employee or beneficiary, and I've kind of highlighted the statute here in the code. So any administrator who fails or refuses to comply with that request within 30 days of such request can be personally liable and up to in the amount of $100 a day. So it can be very expensive. Now the days are max. There are some daily limit maxes that would be applied, but you easily can get into 6 figures of a number if you fail to provide a summary plan description upon request. So this number one mistake is really huge, and I will say this. Many employers, as I've mentioned it with small employers, maybe many employers do not know what they do not know, right? They're not aware. You know, certainly if an employer offers a retirement plan or a pension benefit of some kind, listen, their broker-dealer, their financial advisor, their record keeper, you know, they're really managing a lot of the ERISA-related documentation on a regular and annual basis, right? I mean, so an employer doesn't have to worry too much from a pension benefit side. But on the health and welfare benefit side, who is supplying the SPD? It's not the carrier. It's generally not a TPA, a health claims TPA, you know, that may be out there. So it's up to the employer, it's up to the plan sponsor to ultimately provide, to implement, create, adopt that ERISA plan document and the SPD. Mistake number two is deducting employee contributions without a Section 125 plan document. So I know, you guys are saying right now, Steve, wait a minute, we're talking about ERISA here. We are talking about ERISA. We're not talking about a cafeteria plan or a Section 125 plan document, right? Well, as our team looked at many of the common mistakes that employers are making, we have found that there's missing documentation here because it's critical to collect this information when you are creating the ERISA plan document and the SPD. So as we are preparing, as an employer would prepare their ERISA documentation, within the ERISA plan document, the SPD, you must list how the funding methods occur. You know, how are premiums paid by the employer and the employee? Kind of a critical piece. We need to understand, hey, employer, are you offering this benefit as a pre-tax benefit? Are you offering it as an after-tax benefit? And those funding methods then are inputted or added into the ERISA plan document. So this common mistake is where employers come back to us and say, well, I don't know. I don't have a separate document for that. We've been pre-taxing, you know, for the last 3 years or whatever the amount of time is, but I don't have a specific document. Well, now we cannot list says that you are pre-taxing the benefits under an ERISA plan if you've not properly documented it through the cafeteria plan. Okay, so this could have a serious domino effect here for an employer, and we have unearthed some of these domino effects. So the IRS is the grand enforcer of Section 125, not the Department of Labor. So this could be a separate audit, you know, that occurs specifically with your client. But let's look at some of the domino effect for failure to have just a simple Section 125 plan document. So first off, the company could have or would have, if the IRS audits and presses, where the employer would have to amend their corporate tax returns. Okay, that's no easy task. It's costly, financially, timely to do that. They would have to amend it. Why? Because they didn't have a plan document that stated that they indeed were allowed to pre-tax those premiums for their employees. So no document, no plan, no pre-tax contributions. So they'd have to amend their corporate tax return. They then would have to potentially amend their W-2s going back however long for all employees who had those deductions. Wow, how are we're going to notify those employees now? We're now going to amend all of these W-2s. Very costly, and now you're kind of disturbing your employee population. Thirdly, there's the possibility, depending on how the IRS handles this audit, where the individuals would have to amend their own personal tax returns for those that were affected. If you're amending the W-2s, you might have to amend previous tax returns to be made. And then lastly, the IRS is going to ask this very important question. So, okay, so if you had a Section 125 plan, that means you would have to perform your required annual non-discrimination testing. Let's go through that test. Oof, what does that reveal? What does that show? You know, ultimately here, an employer. So this particular mistake, as you can see, could have an extreme domino effect. Not only does it affect the ERISA documentation that an employer is going to provide, right, ultimately to its employees, stating exactly how the funding options are going to exist. But now on the other side of the aisle, there could be a potential for an audit from the IRS in regard to the Section 125 plan in total. So your question, right, your reminder here is that you've got to ask the question, don't assume that your employer has those documents. They need to have those documents, and you can be really at the center of attention in pointing out in a very big way what could happen if they do not have the plan documents in place. Mistake number 3. Creating a self-administered FSA or HRA without appropriate documentation. All right, so we have noticed it doesn't apply, or it hasn't happened as much with a self-administered FSA. I mean, many employers utilize an outside party to facilitate their flexible spending plans. It's very common. Some do self-administered, but where we see self-administered options quite a bit is on the HRA side of the aisle. So what's very important to realize with ERISA documentation, so think about the process in what a company such as PrimePay, as we're fulfilling those documents for the employer, we need to accumulate a lot of data on their benefit plans. We need to ensure that we've captured all ERISA qualified plans. So whether you're fully administering the plan or not, we need to ensure that we're covering all of the details. So within the ERISA documentation, we're going to list that you do, employer, have a health FSA, you have an HRA, but wait, we need to take that a little step further. We're going to need to define the eligibility for the HRA and the funding methods, right? I mean, how are you funding it? What kind of accounts are you putting this in to make these reimbursements to these employees? So the eligibility and funding is actually very, very important. And again, what we are finding is that employers who are using this approach, they are not going forward with the appropriate documentation. And so to some degree, there's a little bit of consistency here between mistake number 2 and mistake here number 3. But what Section 105 and 125 demands, so a health FSA and an HRA, what it demands is that they must have a written plan document. This is a separate document outside of the ERISA plan document or the ERISA SPD. Okay, it is required to have a written plan document for the health FSA. The same applies to the HRA. What also applies is the summary plan description. You certainly have specific summary plan descriptions that would be given to the employees to describe those specific benefits. And lastly, which we know is not being done with any type of regularity, is that they're not performing the required annual non-discrimination testing on the highly compensated employees and also on those plan contributions. So it's very important that these documents, this documentation is also moving along with the health FSA and HRA, because as part of the documentation within the ERISA plan document, we need to include that information appropriately there. So here's a little reminder, okay? And this is where it gets very comprehensive. The ERISA plan documentation is going to include, I mean, a lot of information, right? But it's going to include all eligibility information on the plans. It's going to include the waiting periods on those plans. The specific funding methods. How is it funded? Pre-tax, after-tax, and so employee, employer contributions that would be made for those specific benefits that would be there. And lastly, I've listed this because I would say that almost 10 out of 10 employers are failing to have this in writing. The variable hour employee measurement period timelines that are required under ACA, or I should say this, employers, applicable large employers, are to monitor or measure their variable hour employees through various lengths of measurement periods to determine benefit eligibility and coverage, right? That needs to be in writing. Where is that going to be placed? it's actually going to be found in the ERISA plan document within the SPD. I mean, variable hour employees need to understand what those timelines, how am I going to be measured so that I understand, how I might be able to be eligible for coverage if I get over a certain number of hours, which is 30 hours, on average each week. So this documentation is very important, and ERISA, since it touches so many other benefit offerings, you want to ensure that your employers are also covering their documentation needs for the Health FSA and for the HRA. Mistake number 4, small employers segregating assets for self-insured plans, FSAs, or HRAs. Now, this particular common mistake is focused on a smaller employer, but large employers make these similar mistakes. And so segregating assets, if you guys kind of think about ERISA, you think there is a funding opportunity, right, in creating an ERISA qualified plan, how an employer funds that particular benefit can create or not create an ERISA qualified plan, okay, or account, I should say. And so it's important for most small employers, clearly, to segregate or not to segregate their assets. So let me kind of give you a scenario here of what I'm talking about. And where we see this a lot is with an HRA type of a plan, right? So many of your employers offer a health reimbursement arrangement today. The employer has adopted a high deductible health plan of some kind, and instead of having the employee be fully liable for that deductible, they've created or adopted an HRA to reimburse portions of the incurred expenses that would flow through that deductible, right? I mean, it's a great benefit that many employers provide. So the typical scenario that we see is, an employer hires an outside vendor, partner, a third-party administrator to administer their HRA. They adopt the HRA, but that employer is still concerned with, how are we going to reconcile the disbursements, the reimbursements that are made out of this account, right? So what does the employer generally do? What we see out there today is that an employer will generally open up another employer-based account, generally speaking, in the employer's name, okay? So they've named it the ABC company account, okay? Many employers will fund it with a portion of the estimated liability or fully fund the account, okay? Some might operate differently, but we see this quite a bit. So what is the mistake? So you said, Steve, I don't know, it seems kind of normal. Most employers do that here today, but there is kind of a potential ERISA mistake here that could be in place. So see, employers must remove any appearance of a segregated or funded account. We have told many of employers that you are not at all to name this account the ABC Company HRA account and then fund it fully. Why? Because now you've created a fully funded ERISA plan, which would require, even as a small employer, Form 5500 filing. Okay, so you immediately get stuck in that requirement. So the potential ERISA mistake is there's this appearance, right? I mean, you've opened up an account, you've funded it with maybe a portion or fully funded it. You now are kind of showing us the appearance that you're segregating your assets specifically for this ERISA qualified plan. The next component is, well, listen, if that money is segregated indeed, maybe this employer just funded a small amount, a portion of the liability of the HRA in that account. If that money exceeds 90 days of being in that account, that actually could create the appearance that that employer will need to file Form 5500, that they've created a funded account. So the result of this mistake could be literally the creation of a fully funded trust account, thus needing to file Form 5500. And as I will share here at the end, the penalties for not filing have increased quite a bit, actually just under 100%. Actually, I say more than, but just under 100% as of August 1st, and I'm going to touch on this. So ultimately, what we need employers to do, and some recommendations that you can provide to your employers to ensure that they're not falling under this mistake. You don't want to create a Form 5500 filing issue if you don't have to, right? So what should they do? So to avoid the appearance of a segregated and or a funded account, employers should really do the following. Please ensure that employers are funding the accounts out of the general assets of the employer. You know, by putting the assets within an account that's labeled the HRA plan, you're not funding that out of the general assets of the employer, okay? So you need to fund the assets, fund those accounts out of the general assets. So generally, the best recommendation would be just to pay or reimburse those premiums and expenses, however that HRA is being established, out of the employer's general checking or operating account, okay? And not necessarily even creating a new account. However, if they did create accounts, one way or a good recommendation would be to create a zero balance account, only in the employer's name, not in the plan name, but in the employer's name. And a zero balance account is where no money is put in, but as debits occur, as reimbursements are made out of that account, money comes out of their general checking or operations account to be able to pay for those specific debits that are created. So we want employers, you should be recommending that employers really, let's do this. We've come across here just recently, over the last month, an employer who established a plan in the HRA name, in the plan name, and funded it, and they've not filed Form 5500 for a long time. So it is a little bit crazy, and although they can make corrections today, they can't undo the past. And so you want to ensure that your clients are actually moving forward in the correct way, and that's why number 4 is actually a big mistake. However, it can be easily overcome. Number 5, failure to properly administer the plan in accordance with the plan documents or certificates of coverage. We're going to fly through this one here, but let's just think about this a second. As we start going through the ERISA structure with our clients, and you start getting through the details of the plans, we have to dive into your waiting periods, the eligibility periods, the funding. I mean, we got to get into a lot of those details, right? And what we're finding is that what an employer is stating to us is actually what's not being reflected accurately in the certificate of insurance. And so many employers are administering their plans today with different waiting periods, different hours of eligibility. And I'll give you an example. ACA has now stated that based on the facts and circumstances of someone being hired by you, if they're going to work 30 hours or more, they're considered full-time. Period. That's ACA requirements. In documentation that employers provide, their documentation still states it's 40 hours, it's 38, it's 32, it's some other number. So we now have this disparate number as far as hours of eligibility, or we still have on the books that the waiting period is the first of the month after 90 days, but we know that ACA has now stated that it cannot be any more than 90 days as the waiting period for coverage eligibility. So there's a lot of differences here in regard to what the certificate of insurance or coverage would state versus what a other employee handbooks or other specific items might state. So remember this. The certificates of coverage are controlling, that certificate of insurance, okay, is controlling. The ERISA documentation should mirror the controlling language in the certificates. So again, mistake number 5, easily avoidable, but there's a lot of language that's in existing documents today that have not been properly updated. And so as an ERISA plan document is being created, let's ensure that going forward those are in correctly. Number 6, filing one 5500 form for multiple benefit plans without a wrap document. Hey, that's not a mistake other than that last piece, right? This wrap document. So can an employer simply file one 5500 form for multiple benefit plans that they have? Absolutely. They can do it all day long. But what we're finding is many employers have tried to simplify the process more than they should have, and have submitted one 5500 form, but without a corresponding umbrella or wrap document. So let's go right to the result. What happens if an employer makes this mistake? All right, so first off, it would be automatically determined that it was incorrectly filed. So that's kind of a no duh, right? If you don't have a wrap document that wraps all of the plans into one document, you cannot file one 5500 form for just all of those plans. So technically, the filing would be considered delinquent. Now, as I'm going to share here just in a moment, penalties have increased quite a bit. And as of August 1st, making this a very costly mistake of employers of doing this specific mistake. This happens more than we'd like to think, actually. So it happens quite regularly. But how do you overcome this? So what you first need to do is ensure that as an employer, you have merged any and all ERISA qualified plans into one umbrella or wrap document. Now, a small employer that only has a couple plans, it might be very easy to create a plan document, but then separate SPDs for every single benefit offering. I mean, if a Form 5500 isn't required, that might be an easy thing to do. Larger employers, though, with multiple benefit plans, what employers are trying to do is simplify, right? Be more efficient. Why should I have 6 different SPDs or documents when I can create one umbrella or wrap document that encloses or encompasses all of those into one? And guess what? Then that employer only needs to file one 5500 form, whereas as separate documents, as separate plans, they might have to do 4 or 5 or 6 different separate filings. So it can be much more efficient. But unless an employer has wrapped everything with those plans within a document, they cannot just file one 5500 form. So a key note here that you want to take out of this as well: can any employer put the plans into one wrap document? Absolutely, they can. All right, but consider this. Consider the number of participants covered in each plan at the start of the plan year. Very important, because there could be some instances in which an employer might have been small enough that if they had kept them separate, they would not have to have filed Form 5500, but by combining them into one plan, that it could push them over that 100 covered participant rule at the start of the year and actually then have to file. So you do have to look at it. Those employers that might be on the bubble there of 100, you might want to consider that, but setting up these documents in one wrap document is a no-brainer, makes a ton of sense. Number 7, the last mistake here that I want to cover here with you, and it is a big one. I will say that when PrimePay got into providing ERISA compliant services, I guess I was a bit naive. I guess I assumed that employers were doing their part in regard to filing Form 5500, you know, timely, as needed. I assumed that. Boy, was I wrong. Many employers are failing to simply file Form 5500 for their health and welfare benefits, or sometimes even worse to some degree without an extension, filing late 5500s. Where we are seeing this common mistake mostly played out is around the fully insured plans. I think that there is some indication that employers felt, well, maybe carriers are providing this benefit in some way. So, you know, an alarming number of fully insured plans are failing to file Form 5500, or certainly in a timely fashion. So let's go over these rules here once again. We're not going to cover the proposed rules, just the current rules here. So large employers, which is 100 or more covered participants at the start of the plan year. What has been a common point of confusion is that many employers are thinking that it's what counts is the number of participants at the end of the plan year. That is not the case. How many covered participants did you have at the start of the plan year? So it's the starting block. It's not the finish line. It's when you're starting the race. It's when you're starting that plan year. That's a big cause of confusion that we have seen. The employee count is different. Another part of the confusion, if they have created a wrap document, I'll give you a for instance here with this where it says the employee count is different for wrap plans. It's based on covered participants, unique covered participants, or those enrolled employees. So let's say an employer has 125 employees, but let's just say, for instance, they have only 85 or 85 employees who are enrolled in that medical plan. Okay, in and of itself, that's okay. That's not a Form 5500 plan. Okay. But let's just say this employer actually contributes 100% of the premium for the dental plan for all of the employees. And they have 125 people that they cover. And also, this employer has wrapped, they have created an umbrella document including the medical plan benefit and the dental together. Well, this employer would be required to file Form 5500 because they have more than 100 covered participants on that plan. So whereas they didn't need to do it for the medical plan, they now would be required to do that. So just as an example, that the employee count can be different as it relates to a wrap plan versus separating the documents. Not that it's negative in that example, but the employee count can be different. And then also, just key to this as far as timing and late filing, it is due the last day of the 7th month after the end of the plan year. So for your calendar year plans, it would be July 31st of the following year, is when that due date is needed, when that deadline is there. And then you could, though, provide or ask for a 2.5-month extension. So here's what I would recommend. This is actually a big deal, and as I show you the penalties, it's very prudent that employers get up to speed in regard to their filings. So here's our recommendation to you for your clients. Be proactive. Don't put your head in the sand, okay, here as it relates to ERISA and health and welfare benefits. Be proactive with them, stating what their obligations are. If you come to find that they are not up to speed in their filing, the Department of Labor has created the Delinquent Filer Voluntary Compliance Program. And what that does is it allows employers who have recognized that they have failed to file, either failed to file or failed to file timely, to be able to kind of just say, I made a mistake and I am voluntarily coming in and I'm going to file. And what the Department of Labor has done there then is that they've capped kind of those potential penalties and fines for the employer, okay? There is no statute of limitations on filing Form 5500. And so if an employer does not voluntarily go in through the delinquent program and they do receive an audit, the sky is almost the limit, and it'll go back years in regard to the penalties. So you want to make sure that you're being as proactive as possible. I am amazed at how many employers are delinquent here in this manner. So an important update here for you, and I actually think that this was one of the updates that came out at the very end of June. It was very quiet. Everybody's on vacation, right? I mean, nobody's even going to look at this. But they have actually provided increases to virtually all of the potential ERISA penalties and fines, okay, that the Department of Labor would find in a specific audit, okay? These increases are final right now. And so I want to just touch on some of the key penalties and what these actually are. So prior to August 1st, 2016, if an employer failed to provide a copy of the SPD, the amount there is it was $110 per day. So you're very familiar with the $110 rule for most of the Department of Labor penalties. That was $110 per day, but it was subject to a $1,100 day max. So it did cap it. So even if an employer had 100 employees and they failed to provide a copy of the SPD, they still were capped. But if we take that cap of 1,100 times 365 days in a year, that's a $400,000 fine. Okay, so on 100, on 100, or at least on that max. Okay, that would be there. As of right now, as of Monday, that now goes to $147 per day and is subject to a $1,472 max. So the maximum exposure again to an employer over a year's time would now be $537,000 for failing to provide a copy of the SPD. What if an employer just fails to furnish ERISA notices? What if they just fail to provide all the additional notices and disclosures? That was set at $1,000 a day. It is now at $1,632 per day. Per instance, failure to refusal, I should say, to properly file the plan's annual report. So this is where if a employer fails to file, okay, they fail to file Form 5500, that penalty was $1,100 per day. That now has increased to $2,063 per day. So again, not quite 100% there, but pretty significant as it relates to an employer not filing. That's per day. So you can, and I didn't show or reflect necessarily the penalties that would be in tow if an employer chose to go through the delinquent filer program, but it is significantly less if they do that proactively. The next, just the last two that I want to show here is the failure to provide documents requested by the Department of Labor. So what if your employer cannot even produce the documents, not willfully refusing, they actually can't comply. So that goes from $110 a day, subject to $1,100 max, all the way to $147 or $1,472 max, so similar to the failure to furnish an SPD. And then I found this one actually quite interesting. Most carriers today, or your TPA, will provide the summary of benefit coverage to you, and it is up to you. You are the plan sponsor to distribute, as an employer, is required to distribute that then to the employees. Well, if there is a willful failure to provide an SBC, that was at $1,000 per failure. That now has increased to $1,087 per failure. Significant, right? I had a conversation with a benefits broker here just a little over a month ago, and we were talking about his clients and these audits that are going on. And he told me that in the last 12 months that he's had 3 employers of his gone through specifically with the DOL ERISA audits. Three of his. And so the story here is that the ERISA game has already started. Okay, it's already begun. ACA has changed its target, the Department of Labor's focus on health and welfare benefits as it pertains to ERISA. A question that has come up, do these penalties only apply to applicable large employers defined by ACA? No, it applies to all employers of any size except a government entity or a church, generally speaking. So these penalties apply to everyone. So what do we recommend? What we recommend is this, and I mentioned it here before, don't hide from this. You are the most trusted advisor as it retains here to certainly ACA, HR, benefits, so many more other things. But it gives you the opportunity to really enable a discussion around how an employer needs to fulfill their obligations here under ERISA. Allow your agency to truly grab this compliance ball and run with it. Don't stick your head in the sand here. Ask the hard questions. You see some of these mistakes? Go through it. Hey, how are you funding your assets? Do you have a Section 125 plan, a Section 105 plan? Do you have plan documents and SPDs actually for those types of plans? Hey, wow, you're pretty close to 100 employees. What have you done here recently in regard to filing Form 5500? Ask those hard questions because ultimately you need to detail their obligations. You can leave it up to them, right, at the end of the day, but you sit in a wonderful seat to be able to share that obligation and really drive strong value to your client. So I just list here 3 steps that you need to do and also the employer needs to comply with, but you need to communicate. Begin that communication. Get your clients, if not what we see, 9 out of 10, or the Department of Labor sees 3 out of 4 employers out of compliance. You've got to understand that roughly 70, 75, 80% of your employers are not doing what is needed as it relates to ERISA. So begin talking to them about how they can comply. And then lastly, where these penalties come up is not just for the filing, but are you distributing these documents timely and accurately to your participants, to those enrolled employees? So very important that that distribution, ultimately takes place. So, I want to thank you for attending. This talk is kind of scary to some degree. I see some questions that are like, this is crazy. Yes, and how you might look at it, yes, it is. But what I want to say is this, is that these 7 mistakes, common mistakes, they are very commonly made, but they are easy to overcome. And I know that many of you have selected PrimePay and utilized PrimePay's compliance services here for ERISA. But if you're not today, we'd love to share more how we might be able to get involved and ensure that your clients are in better compliance here with ERISA. Because mistakes can be made, right? But that's okay. We want to make sure that your clients are doing the due diligence, and PrimePay can certainly handle that for you. You can seek us out by finding us on Broker Concierge, either on Twitter, LinkedIn. Certainly you can email us if you have additional questions. We do have some follow-up material that we will have for you. We will provide a link to the recording. We have some very good pieces of information that can share a little more about our ERISA compliance services. That's for you, but also a client flyer. And then for our Broker Concierge partners, we've got some exclusive items for you. You will receive a copy of the presentation slide deck that was used today. You have the opportunity to use that as needed internally or with your clients. And we also are going to provide just a couple more levels of detail in regard to a reporting and disclosure flyer and also a terminology flyer that I think you might find useful. We would love for you to join us here the first Wednesday of September 7th. It is, the fourth quarter renewal season is actually probably well underway, right? But what we want to do is talk about kind of 5 key strategies that you might want to consider and have conversations with your employers as you head into this renewal season. So we are excited that you're able to join us here at the next webinar. Thank you for attending today. Look for our follow-up emails coming shortly, and also go to our YouTube Broker Concierge channel to be able to view this most recent webinar. With that will conclude our webinar. Have a great day, and we look forward to talking to you very soon. Thank you. Bye-bye.